John says, I recently put on a long collar that I got off the site on DVN. Both the call and the put were February options expiry, and unfortunately I forgot to have the put further out in time. That's okay. Standard collar still gives you good control. Excuse me, you sold the 44 call and bought the 42 put. DVN is now at 48.89. Should I roll the put out to a further expiration month? Okay. So let me make sure I have both here, and I do not. Got to add long collar. Let's go to other strategies here on power options. And for the moment, let's go ahead and take out bull call debit, and we'll add long collar into the position. All right, save configuration. Now, I use long collars in my portfolio. Last week, we had a discussion a little bit on allocation, and that was shown in one of those married put topics a little bit, where about 50 to 60% of my portfolio, actually right now it's 40 to 50, that's going to be increasing next week. Those of you that just subscribed to Fusion, you're probably going to see one trade. You're going to see one trade at least next week, one new married put trade in the Fusion portfolio. And the following week, you might see another or potentially two more. So I'll be back to that 50 to 60 range. But that 50 to 60% I allocate into what I call the married put or protective positions. Most of that is in the straight married puts that are shown on the Fusion portfolio at RadioActive Trading. There are a couple of long collars that I have in there as well. A long collar to me is a different sort of trading plan. It's like you open, John, or you found it on the site. DVN, I might have been neutral to bullish on over a 25 to 30-day period, rather than just sell a covered call, which done correctly can be a very lucrative strategy also. But I'm adding an extra out-of-the-money put for protection on the position. In general, when I do one of these collars, John, I'm not planning it for a longer-term trade. It's something that I just had an outlook that for 20 to 30 days was a good trade and a good premium potentially for a covered call, but I wanted to take that extra protection in case the market did something different, like we saw in the first couple days of January and some of the declines and the pullbacks that we've had. If the stock is usually above the strike price of the call, I typically would just let this trade be assigned, like a covered call, make my 2.5%, 3% return for whatever time frame I was in. I initially was not planning on continuing the trade long term, using it just like an in-the-money covered call. Or if it gets assigned, I take the profit and move on. If I'm wrong and it falls, I'll take the loss and move out rather than try to get to a break even on this position that's going in the opposite direction of what I want for the strategy. I'll just move on with that controlled risk of 3-4% or so and look for a new position later on. So I usually approach it two different ways. If I was very bullish on DVN, meaning I thought that in the first 20 to 40 days, I might see a 3 to 5% increase in the stock, but in the next 2 or 3 months going forward, I expected to see an additional 5 or 7% increase on the position. That's when I'm opening it as a radioactive married put. And yes, I'm going to do income methods along the way. Are there opportunities where you could move this? Yes, but just like in a married put, if I had sold a call against the position, just a straight covered call. I get these questions from time to time, John. Someone says, I have a covered call, but I'm interested in your married put approach. Should I buy a put now? I bought my stock at 42. I sold the 44 call. It's at 48. Should I buy a 50 put? Absolutely not. You have to deal with the call first in those scenarios, because the last thing I want to do is have a put that is a higher strike price than my call, unless I'm bearish, because that will create a bearish structure. Let's take a look. So you said earlier that you found this position on DVN. Let's just go to the stock page real quick, and we're going to bounce over to big charts. And there's the good moves. So let's say, let's go 1 month back. I'm sorry, I want to see the actual dates so it's easier for me to look up historically. We're going to estimate in this case, John, okay? So, yeah, right about here in this area, the stock's at 42. December 21st, December 22nd, somewhere in that time frame. That's where you might have entered this position. Let's go back to power options. Let's go to the option chain for DVN. And I'm sorry, let's go back to December of 2021. All right, so no, 41.31. I don't think you would have done it then. Let's go to the next day. 42.29 is probably better. 42.05. Okay, just one more. Let's go to the 27th. 44.61. Okay, so I'm going to assume you did it at this time. We're going to take 42.29. Okay, it's on 12.31. Okay, John. You did it on 12.31 when the stock pulled back a little bit. Great. 44.05. Okay, so you did it right at the money collar. Pretty good. And let's go to February. Did you say February options? I'll just use February 18th. 43.70. You said okay. That's fine. 43.70. All right, John. But I'm just going to use these prices anyway. Our 44 call at about 328. 42 put at 230. So 328 and 230. Good. Why is it really necessary to analyze this? Well, it's going to help. So I really want to take a look here at what some of these premiums and what this structure is, even though the prices are going to be a little bit different. Okay, add stock 100, 43.70. I'm still going to use those call and put prices for the 18th of February expiration. My apologies. 44 call, 42 put. 328, roughly. Oh, sorry, folks. Didn't click over fast enough. 328. And this was at 230? Yeah. Let's go ahead and run that. All right. So, potential return, 3%. Max upside return in the put is at 1.70. Now, had I entered this as a radioactive married put, we might look at the numbers, but it's not overly necessary. What I would have done is likely bought the stock at 43.70, and I probably would have bought something around a 45 or maybe a 47.5 put to control a risk to the downside, let's say 5 or 6%. Sorry about that. 5 or 6% here, depending on the prices, although these look inflated, but that's okay. And now that the stock has moved up to 48.89, I have a good liquidation value on that static married put, but I might consider rolling the put up via income method number 4, one of the 12 income methods, which would have cut my risk down by more than half, might have even bulletproofed the position. In that case, with the one move, now that the stock's close to 49, it might have gone to the 52.5, the stock knocking on $49 and $50 per share right now. But you're not in a married put. You're in a collar in this case, okay? And what the one thing I don't want to do, John, is I don't want to just look at this put and say, hey, the put's losing money. It's now further out of the money. Let me sell to close the put and go up to a higher strike. Let me do this first. We'll just go up to 49. Now let's go to 50, okay, for the same expiration. So we're going to sell the 42 put and go up to the 50 in the same expiration. I wanted to illustrate this because what you've done in this case, I call this a bearish collar. I used to do this years ago, back in 2006 and 2007 in Fidelity, when I was only level 2 trading in my IRA account. I could buy puts, I could sell covered calls, and I could buy calls. I had an Options Express account with a smaller amount of money in it, but I didn't have full spread potential yet. Okay, I got that a year or two later, and then now I have other accounts where I trade my spreads and everything along those lines. Why would I even consider this? Well, in a bearish market, all I could do in that IRA account was buy puts or have the married puts for protection and wait it out and then roll the position. But sometimes I would buy a stock. Let's say I bought Devon right now at 48.89, sell the 47.5 call, and buy a 50 strike put, which would create a similar structure to a bear call credit spread, but I could do that in my account and still make 8 or 9%. Now, if the stock stays below the short call strike price and I have the higher put, so I can play a bearish strategy even with only level 2 trading, although it sounds odd, doesn't it, in that case? What am I doing? I'm buying stock to be bearish on it. Sounds ridiculous, but I can still get the same type of collar returns with maybe a 2.5%, 3.5% return if it stays below, and only have a 4 or 5% risk to the upside if I'm wrong and the stock moves up. Why this is important is it's the exact same thing that's going to happen, but in more of a calendar view. If you took this put and rolled it out to a further expiration with a higher strike, you're going to do the same thing. You're going to create a bearish position. Let's just go to July, and we'll stick with that 50 put now at about 810, 820 at midpoint. And what have I done? I've created the bearish position once again because the stock is trading, the put is higher than the short call strike price. In this structure, if you had just bought the stock at 43.70 and sold the 44 covered call and said, hey, the stock's had a great run, I want to protect it with a put, my first suggestion is always you have to handle the call first. If you're planning on longer term hold, John, for further upside potential on a stock that's exceeded your expectations, what's hurting you the most right now? It's the short call. Why am I saying that? Because this removes any of the positive delta that you have in the stock plus put combination. Right now, this is getting deeper in the money. And as you get closer to expiration, the delta is getting closer to 1. That's what's hurting the upside, or any potential further upside, is the call. It's not the decay in the put. It's not that the put is so far out of money. Yes, you can still lose a full dollar on the position. I understand that. But that's not hurting the upside growth. It's the short call that has capped the gains. So what you want to evaluate, if you want to continue this position, you want to first evaluate what is a good opportunity to roll this covered call. Okay, so if I'm in this position, not including the price of the put, January 7th, that's what I needed here. We're just going to put this in, we'll keep today's date, it doesn't matter. Oh, shoot. Oh, it didn't, let me go back. I'm sorry, folks. My apologies. I have to make sure that everything is clear. I just want the covered call right now. I guess I have to submit it. My apologies. There we go. That'll work. Let's try that again, shall we? So we're going to insert it into the portfolio, desired January 7th, 2022. There's our covered call. Okay, let's be accurate, Mike. Let's put in 12/31. Change our dates, match John's position. All right, so there's my covered call. I know this is going to be a hefty buyback price. And that's, again, what's hurting the upside. Why would I turn this into a married put? In my opinion, because I want to have it protected, but then continue the position going forward. Do we have any rollout opportunities? Well, right now, just on the covered call, we're at 5% after 7 days, and we know at expiration, just the covered call without the put price would be an 8.9% premium. There's some opportunities to stay into February, but it doesn't really give me the gist of what I want. I'm going to be rolling for a high depth. Oh, that's pretty decent. I'm a fan of that, potentially. Just rolling up to the 49 call keeps the credit. The 328 you took in minus the 645 buyback, getting 350 for the 45 and 33 cents. Yeah, it's giving you an increase in percent if assigned, but it's still keeping a credit on the call side. But I probably want to go out further, and that's not enough. And then it just jumps to 97. That's tough. Okay. We're not seeing the March series yet. That's complicated. That complicates things a little bit. The March series probably won't come out until January 21st expiration. And I'd want to use that to roll to. But let's stay with that one. Let's stay with the February 49 series. Just rolling up to February 49 to keep a small credit. Why is that important? Because let's go back to our custom spread tool. And Let me put the put back in. Sorry, 42 at 230. All right. So we know our collar graph, but now what we're going to do is we're going to look at rolling this position up, 44 to 49. So buy one of the 44s, sell one of the 49s. On this collar, where does that put us? Well, it gives us a higher risk now of 8%, but 7.3% potential as well. Now, what we could do in this case is take advantage of our put. Now that I've moved the call, what was hindering me the most? As the stock is moving up. Sorry, we're going to sell to close this for $1. I'm going to keep with that July series. Maybe you only want to use April, that's fine. We're going to go to that same 49 strike put. So we're going to close this out and do that. It's going to give us a curve graph. This still gives me two ways to lose, but it's not a straight bearish position where we saw the max risk is not going up too much as it was in that other structure where you just moved the put first and the risk was 12 to 15% this direction. I don't want to have the call below my put strike price by just moving the put and trying to extend this trade. I want to take care of the call first, and then I want to go ahead and add the put option to the position. Okay. All right, let's see here. So that's my answer to that. Fernando tells us that sometimes I start a married put with a sold call collar just to land in a married put with less risk if the stock declines. The call will finance most of time value spent for the put. Right, so what Fernando's talking about is that if he was in that position, he might have started it as a collar to lower the cost, and if the stock did start performing as I'd expected, he'd convert it to a covered call later. I'm sorry, a married put later. But you still have to address the short call, especially if it's in the money, because that's the first thing I feel you want to look at. You want to adjust that call first, then look to converting the trade as well. And Fernando says the idea is to say theta positive to avoid the time against you. Right, but that's also why I like to start off with the farther out put in the first place, because it decays slower than the time premium of the near-term income methods. That's why I start with a married put first if my sentiment is more bullish. And as you mentioned there, Fernando, I will start with the collar in that case. On some of those positions, it might be a married put later, or I might just let it get assigned and move on. Okay? John says, so you should have started with the married put and sold the call later. Potentially, but keep in mind, even though February is pretty far away, you still have a good opportunity here on this position to just let it get assigned, take that initial profit that you wanted, and if DVN, oh shoot, I took out the put. I didn't mean to do that, sorry folks. If DVN continues up, you could enter it later as a married put, factoring in the profit you took from the February position. Okay, that's a possibility as well. But as we saw, you have opportunities to roll. That was 230, wasn't it? My apologies. There we go. You have opportunities to roll now, but I think you want to take care of the call first and not risk converting it just to a bearish position. You could make 3% on this. I want to add this to the portfolio one more time as the full collar trade. Remember, we just did the covered call the first time. Not going to worry about the dates specifically in this case. And the reason why is that I wanted to take a look at this. You expected that 3% return, and in 42 days, you could get assigned to make it. Right now, you're at about 60% if you just liquidated the position and started over. I don't think you need to do that. But again, you could just liquidate it, make 1.9% or $82, and then start the position as a married put. Or evaluate rolling the call to a strike that you think is good. You're going to be sometimes rolling for a debit. I understand that. But then you're trying to convert it to the position. You just never want the call to be below the put strike price, whether it's in the far-term married put or whether it's in a shorter-term collar, unless you're trying to create a bearish trade. And again, what's hurting the position here to the upside, you can see it. You've only lost $121 on the call, on the put, excuse me. And right now you're taking 317 of a loss on the short call to buy back, which is eating up 60% of the gain you have in the underlying security, as that delta is getting closer and closer to 1 as it gets deeper and deeper in the money. Okay, and let's not go hindsight 2020, John. You're still in a positive collar position. I like this one. It's a good return, maybe extra 10, 15 days at a time. It's a good return for a 30 to 40 day trade. I see that. You had great risk protection on this position as well. But again, if you think now that Devon is one that you want to continue as a married put, take care of the call first, then roll the put, see your structure, and as it continues to move up, you might need to roll that call again in that case, sort of as Fernando mentioned, to try to stay theta positive in those scenarios. And so that's what I look for. So same conversation is when I have a customer that calls up, sees some of the married put discussion and says, hey, I'm in a covered call in the stock that's in the money. I'd really like to convert it to a married put. You don't just buy the put at a higher strike price because that creates the bearish position. You have got to move up. In that case, you've got to move the call up first, especially if you're still bullish, then evaluate which put is going to be the best structure for you, for your risk tolerance, and following the 3 core principles we use at RadioActive Trading. Again, of course, described fully in the blueprint with all the 12 income methods there as well.